Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Young-han, professor of economics at Sungkyungkwan University. Professor Kim, good afternoon. It's our first time having you on the program today, so we're honored. Thank you for coming on.
Thanks for having me.
Well, let's start with Wall Street, where stocks continue to go down again substantially on Wednesday as the situation in Ukraine got more serious. Now it does appear that an attack has begun, so the futures are down quite a bit too. The S&P off by 10% from its last high. What's the story in the global markets?
Yeah, overnight, Dow Jones Industrial Average Index dropped by 1.4%, while Nasdaq Composite Index also tumbled down by 2.6%, mainly reflecting the increased geopolitical uncertainty in Ukraine, still not really reflecting the invasion which has started today. And with the Russian invasion started, finally, oil prices and commodity prices will be increased further, adding inflationary pressure in addition to already serious strains in the global supply chains. So I think unless the uncertainty in Ukraine is reduced in whatever directions, I think the volatility is mainly in negative direction in the market might be continued.
It does seem that way, and as you mentioned, the invasion began after the U.S. markets were closed, but during the session here today in Korea, and so stocks were down by an even larger margin here. In fact, we see the big names, they were off by 3%, 4%, 5%, LG Chem by close to 7%. Tell us about the domestic market.
Right, right. So here in Korean market, we started to reflect the latest invasion. So it is reflecting the latest Russian invasion. Kospi index in general tumbled down by 2.6%, while Kosdaq index generally dropped by 3.3%. And as we have expected, Ukraine crisis will affect Korean economy not only by the increase in the international oil and commodity prices, but also South Korea is also expected to participate in the sanctions against Russia. And this participation in sanctions against Russia implies that a general and quite strict export control of semiconductors and other technology-intensive products to Russia might be quite strictly controlled. And that types of export control will directly hit the major Korean export firms, mainly in semiconductor industry, automobile, and other technology-intensive sectors.
Well, this was one factor that caused the Bank of Korea today to keep interest rates where they are, the policy rate staying at 1.25%. Of course, it has raised rates 3 times in the pandemic, most recently in November and January. Tell us about this decision at the Bank of Korea and what you make of it.
Yeah, right. So today, Bank of Korea decided to freeze the benchmark 7-day repo rate at 1.25% today after as you said, 3 consecutive interest rate hike after the pandemic since last August. And till now, we can say BOK has been mainly concerned about possible increasing inflationary pressure with the coming interest rate hike by the U.S. Federal Reserve. But however, the somewhat unexpected new cases like the increasing negative pressures from the geopolitical uncertainty in Ukraine, especially added by the today's invasion by Russia finally, and the latest upsurge in COVID-19 infections here in South Korea have led BOK to freeze the interest rate today in opposite direction till what they have done till now. And probably for the time being, I think they might have some time to watch out the future development of the inflationary pressure here in South Korean market and also in global market, and also the possible, additional negative impacts of the Ukraine crisis.
Well, speaking of inflationary pressure, despite that, the BOK keeping rates steady, but it did raise its outlook for inflation this year from 2% now to 3.1%. It's the first time it's been above 3% since 2012. Some see this as a sign the BOK will move to raise rates in the second quarter. What do you see happening with inflation?
Yes, as you described, you can say inflationary pressures are coming from every direction. Say the first starting point might be the so-called global, very strong strains in the global supply chain just after the pandemics, and the additional outburst of contained demand and consumption, and also accelerated the inflationary pressure. And the latest Ukraine crisis has definitely added much more inflationary shocks, increasing oil price and commodity prices. So in that context, I think that further increase in the interest rate might be somewhat unavoidable sooner or later, mainly to handle the continuous inflationary pressure. But however, the current inflationary pressures are mainly from supply shocks, and as we have discussed, not from a real sharp increase in demand side. So therefore, I think an interest rate hike cannot really resolve all inflationary pressures of what we are experiencing these days. So I think more active policy efforts and measures to resolve serious supply chain deadlock and strains might be also very important to handle future inflationary pressures.
Indeed, it's an increasingly complicated situation, it seems. Professor, we'll have to leave it there for today. Thank you for coming on. It's great to have your insights on the show.
Thank you.